You kind of touch upon this, but the whole idea of just hedging the non-QM production. So it's not going to be as straightforward as hedging agency. You're not going to just put on TBA, MBS and expect it to 100% effectively hedge the risk associated with a complex product like non-QM. So how do you structure strategies to account for these differences, and what instruments have you found to be effective, maybe in addition to or in replacement of MBS?
So I think a large portion of the hedge is going to be your TBAs. And then this is kind of where the art comes into finance in the world of art and sciences. You have to look at your interest rate swaps, your treasury basis. The answer is interest rate swaps, right? And where you decide to land on the curve, volume, ratios, treasuries, that mix is going to be up to you. I would say just on the MSR side, we hedge with some similar products. It's been very, very chaotic. It has been an extremely challenging environment to hedge in with all the volatility. I mean, you had the SOFR Treasury swap widen out, collapse, widen out, back and forth over the last month or so, and even just that spread alone changing, yeah, I can't even tell you the amount of headaches that causes. Right? I think you just have to be similar to the performance of these assets and how they're priced. I think just as much effort has to be put in, especially in this market right now, tracking the performance of your hedges, saying, okay, I know what should happen, but does that actually make sense? And deciding what your mix, your product type is. So it changes a lot. There's no formula that I could just say this is kind of the right way to think about it, except be agile and don't be afraid to make changes when the market changes in ways that probably you don't expect to. A long way of saying it, this is not the market to put the model on a cruise control, right? This is not auto cruise control time.